Our second question is going to move away from just the actual markets we face and look towards the products we manage and how that's been going. Mark, you look after two areas for us, the fixed income and the asset allocation fund, the Reg 28 fund. So maybe you just want to give a quick rundown on how we've been doing in both of those areas.
Yeah, sure. The North Star Income Fund continues to do really well. Admittedly, it's a very nice space, the local fixed income on very high real yields. But we've been navigating the markets quite nicely. This last quarter was strong, 3% in line with peers. Very pleasing to participate actively in an improving environment.
And I'll just say one thing about the fixed income fund, which does make us a bit different, and that is we face having a small portion of that fund offshore in a strong rand environment, struggling global fixed income. So to some extent that fund has a bit of a circuit breaker in it relative to other pure South African fixed income funds, and that's part of our strategic benchmark. It shows that you should own some offshore, and when things go pear-shaped in South Africa, which end up happening every so often, there's an immediate shock absorber in that offshore space. So to some extent our fixed income fund has held up and done as well, and if not better than many peers, but it has to work really hard because it sits with a kind of endowment effect of some offshore.
100%. I mean, that's probably a differentiator. The fund is very well diversified and designed to perform really well through the interest rate cycle, which I think is really good for low risk investors that are looking to outperform cash. And we've managed to do that by a margin of at least 2%.
And I know we're not talking in detail about the differentiating factors of our funds in this question, but just another point on the local North Star Fixed Income Fund is that it has tended to hold very high quality paper. So it's one of the other kind of key criteria, so that if anything does go wrong, we're not sitting with illiquid paper that's not the same quality as that we deem appropriate, really, for the kind of client that goes into that product. Correct?
That's 100%. Yeah.
And we'll talk to that a bit later. All right, Mark, so how's domestic equity done?
Yeah, so the fund had let's call it a fair quarter and 6 months. So over the last quarter we lagged marginally some of the peers, but year to date we're looking all right. We're roughly in line. The fund has been very well positioned. We kind of got a lot of trades right. We were underweight precious metals, which boded well. We were long industrial metals, which held up quite nicely. We got the rand hedge trade right, and we're very pleased with a lot of our positions, like some of the mid-cap positions like ACI, Premier, and a few others that did really well for us. Against this, being overweight, the retail space hurt us. And a couple of positions that are quite large in the index, like MTN, Capitec, Outsurance, which did extremely well and hurt us from an attribution perspective. But overall,
we didn't necessarily own those positions at full index weight.
At full index weight,
we might have had some exposure, but the valuation framework that you use hasn't allowed us to own full exposures there.
That's right. Yeah. So it's a fair 6 months. Then over 12 months, a bit of a harder time for us. Q4 2025 was a bit tricky given some of the extreme movements in commodity prices that we saw. We're quite happy that some of these positions will correct over time. Over 3 years, the fund is doing really nicely and roughly in line with peers, and over 5 years, we're quite happy. So we're just hoping that a lot of the embedded opportunities in the fund that we think that are very attractive and cheap at the moment will start paying off. So the drag that we've kind of carried for the last few years starts paying off over the coming few years.
And one could basically define the fund as an investor's kind of fund, because we own real businesses that we believe are fundamentally undervalued.
Yeah.
And we will hold them until they appreciate to what we deem to be appropriate values.
Yeah, 100%. I mean, I think Donovan mentioned it, and you've certainly mentioned that, we're quite valuation driven in terms of philosophy. So trending markets where valuations go out of tilt don't necessarily suit us. So extreme environments are quite hard for us. But fortunately for us, these type of situations do normalize over time.
So a very strong trending momentum market where we've lost kind of the North Star of valuations. We're just going to struggle in that environment. And maybe
Exactly.
gold trade where gold stocks reached ridiculous valuations late last year was something we just couldn't contemplate any longer, although we had them early on and we exited them probably a little bit earlier. So we're carrying some of that kind of momentum in the numbers for the last year.
Yeah.
All right. Donovan, and for us at North Star, our kind of shining light for years on the offshore side has been our biggest detractor this year.
Yes.
We're facing that in the balance fund because we own our global fund. And let's just talk through, what's been happening offshore for us.
Yeah, so I think I'll first put in the context of the year 2026. I think our style hasn't really suited these narrow markets that have been very much momentum driven and semiconductor driven. So you've seen we've performed quite similarly to a lot of quality managers, and we've underperformed the equity index in comparison because of that. For the past quarter, the fund did deliver a positive return, but our relative return was overwhelmingly impacted by our limited exposure to semiconductors and as well our overweight to software and IT services, which is sort of acting like the inverse trade at the moment. But in terms of the numbers, the North Star Global Flexible Fund delivered 6.4% in the quarter, and relative to the Morningstar peer group median return of 7.3% were slightly behind. And when you take a look at the equity component, you'll see there we delivered 8.7% versus the MSCI World that delivered 13.9%. So that 5.5% underperformance was driven by stock selection, and really about 4% of that 5.5% was driven by semiconductors and our underweight and limited exposure there. And then the remainder can be put together towards our kind of overweight in software and IT services, and a bit of other companies like Visa and MasterCard that have been put into the AI loser bucket. And then just looking at the quarter, I think the largest detractors, two of the companies that detracted the most we don't own, and that was Micron, that delivered over 200%, and AMD, which delivered 150+%. So that together with Adobe and Cognizant, which is our software exposure, resulted in negative attribution. But again, on the positive side, we had a few good things. So on that part, we had Intertech performing very, very well, and that was on valuation and a potential buyout, which is coming through. And we actually reduced that as it reached closer to that fair value. And then we had an area of the market which was rewarded, which was cybersecurity. So Palo Alto performed well, and then we had a good performance from Elevance, and then our exposure to ASMR benefited from the semiconductor trade. So I think to summarize, we owned a bunch of businesses that performed well, but it was overwhelmed by a narrow universe of semiconductor stocks that delivered extreme returns in the quarter. We hope that the market broadens out and that valuation becomes more central rather than narratives. And as managers of equities, you generally look over a longer cycle. We see that the North Star Global Flexible Fund has delivered on our promise, and it's in the top third over 10 years, despite a trickier shorter term period.
So if I can sum that up, we've had our toughest 6 months ever, and we've been doing this for 14 years, and we've outperformed the index, I think, for 9 or 10 of those 14 years, calendar years in terms of positive alpha. But we're going to struggle in periods where there's a binary event in markets that aren't related to valuation. Again, and the central theme at North Star, we back off when things go ballistic. And I think our biggest concern right now, if I can add, in the offshore space is capital preservation. As much as it is delivering relative returns, we think there's a potential for massive capital loss in certain portions of the market, and unfortunately that's the portion of the market gaining the most amount of traction. So we've backed off from that, and we've seen this play out many times over our history.